Welcome to the deep dive. Ever wondered how companies that actually make things, track their finances?
Yeah, it's definitely a different ballgame compared to just buying and selling.
Totally. It's not like your average shop. So today, we're diving into manufacturing accounting. We've got some great learning materials to guide us. And the goal is really to break down how manufacturers track costs, manage that inventory, especially the half-finished stuff, and report everything.
And hopefully do it without getting too bogged down in super technical jargon.
Exactly. We want you to get a clear picture.
It boils down to that act of creation, doesn't it? Retailers, wholesalers, they just pass goods along.
Right.
Manufacturers transform raw materials, and that transformation adds layers of cost tracking. That's the core of manufacturing accounting. Makes it pretty interesting, actually.
Okay, let's start by unpacking some key terms. It feels like learning a bit of a new language, but it helps everything else click into place.
Good idea.
First up, direct materials, or sometimes called raw materials. What exactly falls under this?
Okay, so think of direct or raw materials as the absolute core building blocks, the physical stuff that ends up in the final product.
Right.
Accountants see them as assets, and companies often use what's called a perpetual inventory system to keep, a running count.
So like wood for a furniture maker.
Exactly. Or flour for a baker, cement for a construction crew. You can physically point to it in the finished item.
Got it. The main ingredients. Okay, next term, work in process. That sounds, well, like it says in the tin, stuff being worked on.
Precisely. Work in process, or you'll often hear WIP, is the running total of costs for everything currently on the production line.
Costs like?
Well, it includes the raw materials that have been pulled from the storeroom and put into production, the wages of the people directly working on it, and a fair share of the general factory running costs.
Okay, so back to the furniture. Once the wood's cut and being assembled?
Yeah. The cost of that wood, the carpenter's time spent so far, maybe a bit of the factory rent allocated to that table, it all gets bundled into the WIP cost. It's basically the value tied up in those partly done goods.
Makes sense. Raw materials started off, WIP is the middle bit, which logically brings us to finished goods. That's the end result, ready to go.
Absolutely. Finished goods are the items that have made it all the way through production. They're sitting there, complete, ready to be sold.
And their cost includes everything.
Everything production-related, yes. The direct materials, the direct labor, and all the factory overheads that were necessary to make them. So your finished tables, the baked bread, the boxed-up shoes, all done.
Okay, clear progression there.
But factories use other stuff too, right? Things needed for production but not actually in the final chair or cake. Is that indirect material?
Spot on. Indirect materials are consumables necessary for the manufacturing process, but you can't really trace them directly to one single product.
Like oil for the machines? Perfect example. Lubricants, cleaning supplies for the factory, maybe glue in some cases. They're essential, they get used up, but they're not a primary component you're selling.
Right, keeps the wheels turning behind the scenes.
Yeah.
Now, labor seems simple, but again, we have direct and indirect. What's the split there?
Okay, so direct labor is pretty straightforward. It's the wages for the employees who are physically hands-on making the product.
The people on the assembly line, or the bakers mixing the dough.
Exactly. Seamstresses, machinists, assemblers, their work directly transforms the product.
And indirect.
Indirect labor covers everyone else in the factory who supports production but isn't directly making the items. Think factory supervisors, the maintenance team keeping machines running, cleaners, maybe security personnel for the production area.
Got it. Hands-on versus support roles. Now, factory overhead costs sounds like a big catch-all term.
It is, essentially. Factory overheads are all the manufacturing costs except direct materials and direct labor. It's everything else needed to run the factory.
Like what specifically?
Oh, lots of things. The factory's electricity bill, insurance on the building and the equipment, depreciation. That's the cost of wear and tear on machinery, factory rent, property taxes on the factory.
So all the background costs of having the production space operational.
Pretty much, yes.
Okay. And then we hit fixed costs and variable costs. I know these from general business, but why are they particularly key for manufacturers?
Understanding this difference is crucial for, managing profitability and making decisions. Fixed costs are the ones that stay broadly the same no matter how much or how little you produce.
Like the factory rent you mentioned.
Exactly. Rent, insurance premiums, maybe salaries of permanent factory staff. They don't really change month to month based on output.
And variable costs.
They move up and down with production volume. The more chairs you make, the more wood you buy. That's a variable cost.
Your electricity bill might go up too.
Definitely if machines are running longer. Maybe overtime wages for workers. Knowing your mix of fixed and variable costs helps with budgeting, setting prices, and figuring out your break-even point. You know, how much you need to sell just to cover everything.
That makes a ton of sense, especially if you're trying to scale up or maybe navigate a slow period.
Yeah.
Okay, one last term here. Production costs. This sounds like the grand total.
It is. Production costs basically sum up everything we've just talked about that relates to making the product. It's your direct materials used, your direct labor costs, and all those manufacturing overheads added together.
And this total cost is fundamental.
Absolutely. You need it to figure out the cost of the goods you eventually sell, which then lets you calculate your profit. It's foundational.
All right, that terminology lays a really good groundwork. Now, how does all this actually show up in the accounting records? You mentioned manufacturers have some different accounts in their general ledger compared to, say, a retailer. Why the extra accounts?
Well, simply because the process is more complex, right? A retailer buys finished goods, holds them, sells them, inventory in, inventory out.
Pretty straightforward.
But a manufacturer buys raw materials, transforms them in WIP, finishes them, then sells them. The accounting needs to track that journey. So you need specific accounts for each stage, like a direct material or raw materials account. Its whole job is to track the inventory of stuff you haven't used yet, what you bought, what's still sitting in the stores.
Okay, a dedicated tracker for the ingredients. What else is new?
You'll definitely see a direct labor account. This isolates the wages paid just to those production workers, helps analyze that specific cost.
Makes sense.
Then there's manufacturing overheads. This is like a temporary holding place for all those indirect costs we talked about, factory rent, electricity, indirect materials, etc.
Yeah.
Keeping them separate makes it clearer what it actually costs to run the factory itself.
So those three materials, labor, overheads, are the main inputs. How do they get sort of funneled together in the accounts?
They all feed into the big one, the work in process account, or sometimes just called the manufacturing account.
The WIP account.
Exactly. This account is central. It collects all the costs related to goods currently being made. As you use materials, incur labor costs, and allocate overheads during the month or year, you charge them to this WIP account.
So the balance in WIP tells you.
The total cost tied up in everything that's currently unfinished on the factory floor.
Okay, it really is the financial snapshot of the production line. Then, once things are actually finished, where do those costs go?
Right. When a batch of goods is completed, their total accumulated cost is transferred out of the work in process account and into the finished goods account.
Okay.
So the finished goods account holds the cost of all the completed items you have in your warehouse ready to be shipped out to customers.
Right, so we can really see that inventory flow mirrored in the accounts. Raw materials.
Into work in process.
Then into finished goods.
Okay.
And the final step,
Yes.
when those finished goods are actually sold.
That triggers two main things. First, the sales account records the revenue you got from the customer.
Standard enough.
But crucially, you also need to record the cost of the specific items you just sold. That's where the cost of sales account comes in, sometimes called cost of goods sold, or COGS.
Matching the cost to the revenue.
Precisely. The cost of the sold items is moved out of the finished goods inventory account and into the cost of sales account.
Got it. That matches the expense with the income it generated.
So visually, how do these accounts look in the ledger? Is there a standard way they're set up?
Yeah, there's a typical T account format that shows the flow. Let's take the direct material account.
Okay.
It usually starts with an opening balance on the debit side. That's your inventory from the last period. Then, any new raw materials you buy, cash or credit, plus any shipping costs to get them to you are also added as debits.
So debits increase the materials you have available. What's on the credit side? The credit side shows the value of materials taken out of inventory and sent to the factory floor to be used. That amount gets transferred to work in process.
And then the ending balance.
The ending debit balance is just the value of raw materials still left in the storeroom.
Clear. What about direct labor? Simpler.
Generally, yes. The total wages earned by the direct factory workers, plus maybe related costs like employer contributions for healthcare or pensions, are recorded as debits. That's the cost incurred.
And the credit.
The credit entry represents the total direct labor cost being assigned or charged to the goods being produced. That amount is transferred over to work in process.
Okay. And factory overhead costs.
Mhm.
I imagine that one has lots of different debit entries.
It often does, yeah. You'll see debits for all sorts of things. Factory repairs, the factory's share of the electricity bill, rent, depreciation on machinery, the cost of those indirect materials we talked about, indirect
A
labor.
whole list.
Right. Then, at the end of the period, the total of all those overhead costs is credited out of this account and, again, transferred into work in process. It represents applying those overheads to the production.
Okay, so all three materials used, direct labor and factory overheads, end up being debited to work in process. What does that WIP account look like?
So WIP starts with a debit balance if there were unfinished goods at the beginning of the period.
Right, carrying over from last time.
Then throughout the period, it gets debits for the direct materials transferred in, the direct labor transferred in, and the factory overheads transferred in. That sums up all the costs added during this period.
And the credit side of WIP.
The credit side shows the total cost of the goods that were completed during the period. That value is transferred out to the finished goods account.
And if there's still a debit balance at the end.
That remaining debit balance in the WIP represents the cost tied up in goods that are still partly finished at the end of the period.
That flow really maps the whole manufacturing cycle financially, doesn't it? Costs go in, build up, and then move out when goods are finished. What about that finished goods account?
Okay, finished goods starts with a debit balance representing any unsold completed inventory from the previous period.
Beginning inventory.
Right. Then it gets debited with the cost of all the newly completed goods transferred in from work in process during this period.
So debits are goods coming in, ready to sell.
Yeah.
Credits must be goods going out.
Exactly. The main credit entry is for the cost of sales, the cost of the finished goods that were actually sold. That amount gets moved over to the cost of sales account. The remaining debit balance is your ending inventory of finished goods.
Okay. And that cost of sales figure that gets credited out of finished goods, where does that take us next in the big picture?
That cost of sales account, which now holds the total cost of everything sold as a debit balance, is typically closed out at the end of the period. Its balance is transferred as a credit to the trading account.
The trading account. Okay, now we're starting to see how profit emerges, right?
Yeah, precisely. The trading account is where you directly compare your sales revenue with the cost of generating those sales. So you'll have the cost of sales figure on the debit side.
And the total sales revenue on the credit side.
Right. The difference between the two is your gross profit.
The profit just from making and selling before other business expenses.
Exactly. And that gross profit figure is then usually transferred as a credit over to the main profit and loss account.
And the profit and loss account, that's the final stage. It brings in everything else.
Yes. The profit and loss, or P&L account, is where you gather all the revenues and all the other expenses for the period. It receives the gross profit as a credit.
Okay.
But then it gets debited for things like selling expenses, commissions, advertising and administrative expenses, office salaries, rent for the office, not the factory. Any other income would also come in as a credit.
And the final balance tells the story.
The final balance of the profit and loss account reveals the company's overall net profit or net loss for that period.
Wow, okay. That really walks through how those specific manufacturing accounts feed into the standard financial statements we're more familiar with. It's definitely more steps involved than just retail accounting.
It is. More moving parts to track.
Now, you mentioned earlier that running the business involves more than just the factory. The learning unit talks about combining manufacturing and administrative records. How does that integration work?
Right, because the factory doesn't operate in a vacuum. You've got management, sales teams, finance departments, the admin side of things. To get the full picture of the company's health, you absolutely need to bring both the manufacturing costs and the administrative or operating costs together.
So it's not just about the cost to make the product, but also the cost to, well, run the company and actually sell the product.
Exactly. And the really key thing here is the sequence, the order you have to do things in manufacturing accounting.
Sequence, how so?
You have to figure out the production costs first, materials, labor, overheads. That allows you to calculate the cost of the goods you produce.
Okay, step one.
Only then can you determine the cost of the goods that were actually sold. That gives you your gross profit.
Step two.
And finally, you subtract all those other operating expenses, the selling, the admin cost to get down to the net profit. You can't jump ahead. The production cost is the base layer.
That makes total sense. You need to know what it costs to make before you know the profit from selling, and then you factor in everything else. This detailed view must be really valuable for management.
Hugely valuable.
Yeah.
They can see exactly where the costs are accumulating at each stage and how changes in production impact the bottom line.
Okay. Now, the learning materials also introduce something specific called a production cost statement. What's that about? Is it different from the ledger accounts?
It is, yeah. Think of the production cost statement as a specific standalone report. It takes all the manufacturing cost information we've been discussing from the materials, labor, and overhead accounts and summarizes it neatly for a particular period.
So not part of the formal ledger, but a summary report.
Exactly. It's primarily a tool for management. It gives them a clear, consolidated view of all the costs that went into production, which helps with analysis, planning future costs, maybe figuring out the cost per unit produced.
Okay, a management report for cost overview. What are the key pieces you'd typically find on it?
The core elements are always the big three: direct materials used during the period, direct labor costs incurred, and the total manufacturing overheads applied.
The main production inputs.
Right. The statement shows how those add up to give you the total manufacturing costs for the period, but then it does something else important. It adjusts for work in process inventory.
Ah, the WIP adjustment. How does that work on the statement?
Well, you start with the total manufacturing costs you incurred this period. Then you add the value of any WIP inventory you had at the start of the period.
Because those costs were from last period, but the goods are being worked on now.
Right. And then you subtract the value of the WIP inventory you have at the end of the period.
Because those costs are incurred, but the goods aren't finished yet.
Exactly. So total manufacturing costs plus opening WIP, closing WIP gives you the cost of production of finished goods.
Ah, so it isolates the total cost of only the goods that were actually completed and came off the production line during that specific period.
Precisely. And that cost of production of finished goods figure is super important. It feeds into other calculations.
Like what? The learning unit says this statement is often followed by a trading statement. How do they connect?
They connect directly. The trading statement, as we sort of touched on with the trading account, is focused on calculating the gross profit.
Right, sales minus cost of sales.
Yeah. And the cost of sales, or cost of finished goods sold figure used in the trading statement, starts with that cost of production of finished goods number we just calculated from the production cost statement.
Okay.
But then it also needs adjusting for finished goods inventory. You take the cost of production of finished goods, add any finished goods you had at the start of the period, opening inventory, and subtract any finished goods left unsold at the end, closing inventory. That gives you the final cost of goods sold.
Wow, okay. So production cost statement calculates the cost of goods made, and the trading statement uses that, adjusts for finished goods inventory changes to find the cost of goods sold.
You got it. Production cost statement feeds the trading statement, which shows that initial profit margin.
It's a logical flow. The materials even give a structure for the production cost statement. Start with direct costs, that's materials and labor. Add factory overheads to get total manufacturing costs.
Yep.
Then adjust for the opening and closing work in process
Plus opening minus closing.
to arrive at the cost of production of finished goods.
That's the standard layout. Very clear.
And the trading statement outline is simpler. Sales, less the cost of finished goods sold we just figured out, equals gross profit.
Exactly. A straightforward measure of core trading performance.
Okay, one last area the materials highlight. The notes to the financial statements relating to all this. Why are these notes important, and what kind of extra detail do they give us?
The notes are crucial for transparency. The main statements give you the headline numbers, but the notes provide the underlying detail and calculations. They really let you dig deeper.
So for something like direct material costs, what would a note show?
The note might break it down. It could show the opening inventory of raw materials, then list the total purchases during the period, add any freight or import duties paid on those materials, and then show the closing inventory being subtracted. So you can see exactly how the direct material used figure was arrived at.
That would be really useful for seeing if purchase prices changed or shipping costs went up. What about a note for direct labor?
Similarly, it would likely break down the total. It might show the gross factory wages, then add things like the employer's contributions to pension funds or health insurance related to those factory workers, maybe payroll taxes. It gives you the full cost of employing that direct labor.
More than just the wage itself.
Okay.
And for factory overheads, which we said could be a lot of different things.
Yeah, the overhead note is often quite detailed. It would typically list out the major categories: indirect materials used, indirect labor costs, depreciation charge for factory buildings and machinery, the factory's utility bills, rent expense for the factory space, insurance, repairs, Basically itemizing that big overhead number.
So you can see what's driving the overhead costs.
Yeah.
Maybe identify areas to control spending.
Exactly. That's a key use. It provides that necessary granularity.
And finally, what about the note for the cost of finished goods sold figure on the trading statement?
That note would typically show the calculation clearly. It would start with the opening inventory value of finished goods, add the cost of production of finished goods, the number that came from the production cost statement, which gives you the total cost of goods available for sale, and then subtract the ending inventory value of finished goods to arrive at the final cost of goods sold figure.
So it confirms how that key expense on the income statement was derived, linking back to production cost and inventory movements.
Absolutely. The notes are essential for anyone wanting to properly understand the financial performance and position of a manufacturing company. They provide the context behind the numbers.
This has been, wow, a really comprehensive deep dive. We've covered the specific language, the key accounts like WIP, the statements like the production cost statement, and how it all flows together. It's definitely clear that accounting for a maker is quite a bit more involved.
It is, but understanding these basics gives you such a powerful lens to view how these businesses operate financially. You get insights into their cost structures, their efficiency, their profitability in a way that's unique to manufacturing.
Definitely. Which brings us to our final thought for you today. Considering this level of detailed cost tracking, we've discussed breaking down materials, labor, overheads, tracking WIP. How might this deep financial visibility give a manufacturing company a real competitive advantage compared to, say, a simple retailer or even a service business?
Yeah, that's a great question to ponder. That ability to see exactly where every cost component is going,
Yeah.
it allows for much more targeted decisions, doesn't it?
Right. On pricing, on controlling specific expenses, maybe identifying bottlenecks in production just by looking at cost flows, things that might be harder to pinpoint elsewhere.
For sure. That detailed insight can be a powerful strategic tool.
Well, that wraps up our exploration for today. We've journeyed through manufacturing accounting terminology, the ledger accounts, the production cost statement, and its link to the trading statement. Hopefully you feel you've got a much clearer handle on these core ideas now.
We hope so.
We definitely encourage you to think about how these concepts play out in different manufacturing industries you might encounter, and maybe even explore some further resources if this area sparked your interest. Thanks so much for tuning in to The Deep Dive.